Emily Roland and I are very excited to talk about retirement planning considerations and give you a market intelligence update. My name is Jenna Witherbee, and I'm one of the advisors on the team at 401k Plan Professionals. And we work specifically in the 401k, 403b retirement plan space. We work with many different sizes and types of companies. And day to day, we also work with a lot of participants, the people that are actually using these plans. And this webinar today is a part of our annual webinar series. This will not only be recorded for you all, but it will also be posted out on our different social channels, our website, our YouTube channel. And certainly, like I mentioned, if you have any questions throughout today's presentation, please drop them in the chat, and Emily and I will be sure to answer them either here during the webinar, or like I said, we can take questions offline as well. But our webinar series is not meant to only be focused on 401k. We like to include a variety of topics. We have at least one webinar a month. And whether you can listen to the whole thing or not, it's nice to have the recording. And it's nice too that we're building out our library for you to have these resources on demand as well. Feel free to share them with anybody that you think would find interest in them. And as far as our YouTube channel, I know it might seem different or, a little bit silly for financial advisors. Why do you have a YouTube channel? But really, this is a great way for us to reach people on demand, right? So you can subscribe. You'll get a notification every time we have a new webinar. We won't be bothering you or spamming you with a ton of things, but we like to have our monthly webinars out here. And we have a library of resources out here for you. And we have a financial wellness mini series as well that we've created. So whether you're a plan sponsor or you're a person participating in a 401k plan, I think there's a lot out there, a lot of great nuggets and just valuable information out there for you. So Emily's going to start. She's our guest presenter today, and we're just really excited to have her here. She's with John Hancock, and Emily has a number of accolades, and she has extensive experience in market and industry research. She's responsible for delivering timely market and economic insight to advisors like myself and my team and institutional investors across the country. She's been featured on CNBC and Bloomberg TV. She's quoted frequently in the financial press, including the Wall Street Journal. She's a highly rated keynote speaker at a variety of industry conferences and events as well. So Emily leads the development of John Hancock's quarterly market outlook publication. It's called Market Intelligence. And really today, that's what she's bringing to us. And so she'll be delivering information to us, bits and pieces from her market intelligence. And I can certainly provide this full report to you as well if you're interested afterwards. So Emily, I will let you take it from here. Thank you so much for being here with us today.
Great, Jenna. Thank you so much for the nice introduction, and thanks everybody for joining the call today. I am so excited to be sharing some thoughts on where we're seeing some opportunities into 2024, where some of the risks are, what the economy is doing, and how we're positioning portfolios from here. I do want to leave a few minutes for questions, so please go ahead and type those in the Q&A. Jenna and I will both be monitoring that, and I'll leave 5 minutes for that. So I'll spend about 20 minutes here with some prepared remarks, and then happy to take your questions. So interesting as we head into 2024, I think the key question on a lot of investors' minds right now is really, why the heck haven't we had a recession? This time last year, 100% of economists surveyed on Wall Street said that a recession was going to play out in 2023, and it just hasn't happened. One of the things that we like to watch really closely in terms of understanding where the economy stands right now is this chart here, which is the Conference Board's Leading Economic Indicators Index. The Conference Board's an independent third-party think tank that puts this research and analysis together to really kind of help foreshadow when recessions are coming, when we might be emerging from a recession. So the gray shaded areas on the chart here are recessions in the US, and this is going back to the 1970s. And when the bars are trending from negative to positive, that's when the economy is growing, when we're emerging out of a recession. And when the bars are trending from positive to negative, that's when we're headed towards one. And we really like to use these leading indicators. The 10 underlying components are on the right. So why leading? Well, first and foremost, friends just don't let friends use lagging economic data. So stuff like GDP and inflation's really lagging. It tells us what already happened. We look at things like weekly manufacturing hours worked, which is the top component here in its weight. So if you think about a company that's thinking about laying off workers, perhaps they're going to reduce the number of hours their workers come in before they do that. The ISM index of new orders is my favorite. I know everybody's got their favorite leading indicator, so no offense if somebody's got a different one, but that's going to tell us how demand is shaping up way back in the supply chain. Now, what you'll notice if you look to the right-hand side of the chart, we're deeply in negative territory. In fact, the leading indicators have been negative for 17 months in a row, but we still don't have one of those gray shaded areas. And the reason for that is because we've seen this incredible resilience, particularly across the labor market. The jobs market is still really tight. There are some pandemic era distortions to a lot of this data. So think about the fact that we poured $5 trillion of stimulus into the United States economy in response to the pandemic. That resulted in explosive inflation, which we'll talk about in just a minute. And it also caused a lot of excess savings. So the consumer has also been a really important bright spot of the economy. Those go together. If the labor market's solid, then people are going to continue to spend if they've got a job. And those things are really keeping the economy on pretty decent footing as we head into this year. So we think economic growth can continue to chop along. Businesses are continuing to hire. They're also labor hoarding. What that essentially means is that businesses know how hard it was to hire people over the last few years. So they're very reluctant to let them go. You talk to any business owner, and I'm sure there's many on the line here today. It's a challenging environment to even think about reducing your headcount, as it still is difficult to hire the right people. So again, this kind of idea of all this stimulus, all of this excess savings, slowly wringing inflation out of the system means that we can be in this extended late cycle environment for some time. Now, we do want to think about the idea that we will likely see a contraction in economic activity in our view, and it may happen in 2024. So essentially the way that this works, the kind of anatomy of a recession, is the cost of capital, interest rates, are now extremely elevated versus where they were just a couple of years ago. So the US Federal Reserve just raised rates by 5%. That's a big jump in just over 18 months. They're probably done with it now, and we'll get to that here in just a minute. So the cost of capital is much higher now. It's higher for consumers. Think about auto loans, mortgage rates, credit card interest rates are now over 25% nationally. A higher interest cost also hurts businesses, especially ones that have to take on debt or leverage in order to be profitable. So you're dealing with a higher cost of capital, and then top line revenue growth, sales for companies, is starting to come down. So it was really, really good, especially when we saw elevated inflation. That was great for companies because they could pass the higher prices along to the end consumer. So what happens is now revenues are slowly normalizing. They're coming back off of those record levels that we saw over the last couple of years at the same time that the cost of capital is going up. By the way, you have to use your hands to do this, so I'm glad I'm on video today. So what happens for a lot of companies is that their margins start to shrink. And if you're a company that wants to maintain the same level of profitability and your margins are shrinking, you likely have to cut costs. And the biggest cost that most companies have is people. So that's why the kind of last thing that happens in the economic cycle is that the unemployment rate shoots up. The last shoe to drop, so to say, in the cycle. And again, we're just not there yet. But we do want to prepare for an environment in which margins start to compress and workers start to get laid off, we think that's probably coming and may result in a mild recession, potentially in the back half of 2024. So it's important to think about kind of how to position portfolios for this type of environment. And by the way, when I talk about positioning, I'm not talking about making major changes to your balanced portfolio of stocks and bonds. It's just making some adjustments under the hood to sort of think about what types of businesses could do better on a relative basis in this type of environment. And the first thing that we want to focus on is owning high quality companies. Those are ones with great balance sheets, tons of cash on their balance sheet, a company that doesn't need to tap the capital markets in order to grow. Now, if you look on the right-hand side of the page, these sectors match up to each one of the factors that I'll talk about. So quality is our favorite factor, and the poster child for quality is the US tech sector. Think about a company like Microsoft or Apple. I think Apple's got more cash than most countries have. So we think that those will hold up relatively well in a slower growth environment. Now, the problem is a lot of people agree, and the stocks went up a ton in 2023, as we all know. There's been a lot of ink spilled on the Magnificent Seven stocks. The US tech sector was up 57% last year. So we're not downgrading it as we come into this year. We still like it because of our preference for quality, but we want to think about ways to diversify from US tech stocks and own some stuff that maybe isn't expensive. So we look at value as a way to do that, as you can see on the left. These are companies that are trading at a discount. They're not unprofitable. They make money. Sounds pretty good, right? Our favorite value sector is healthcare. Healthcare did poorly last year. It ranks high on our quality screens. It is a little bit more defensive in a market where we think defense is going to get rewarded. And then finally, bringing it back to defense, another one of our favorite factors, we think there's going to be a big shift in consumer behavior this year. Excess savings have been drawn down. Loan forbearance is gone. We've got trillions of dollars of student debt due. Again, interest rates are very, very high. So we think that people might, pull away a bit from buying and doing the things they want, discretionary things, whether it's vacations or kind of, that next item I always think about my kids with their Sephora and Lululemon. I'm sure you can relate if you've got an 11-year-old daughter. But they're still going to turn the lights on and take a shower. So we think areas like utilities, which we're showing on the right, can really benefit from that shift in the consumer mindset. And utilities are another area that were really left behind last year and are now trading at about a 20% discount to the market. Basically, that means investors are not overpaying for earnings growth in that sector. And then the final idea that we have within the equity space is really thinking about how to benefit from a bigger long-term trend, a more secular trend, which is one of onshoring or reshoring. It's supply chains that are coming back to the United States from China and other areas, and also areas that are benefiting from fiscal spending. So right now there is still government spending going on, right or wrong. We can debate that in a different forum, but it's happening. It's happening via the Infrastructure and Jobs Act, the Semiconductor Chips Act, the Inflation Reduction Act. It's really reaccelerating inflation, but we'll leave it there. And so what we're showing here on the right-hand side of the page is just in the last couple of years, all of the new semiconductor projects and EV plants that have been developed in the United States. So we really want to funnel our investments into where the money's going. And again, a lot of this benefiting from China potentially no longer being the growth engine of the global economy. Really, it's the United States. In fact, I was inspired to build this investment theme based on a conversation I had with one of my favorite economists a couple of years ago. Her name's Nancy Lazar from Piper Sandler, and I was at dinner with her. Unfortunately for her, because I was sitting right next to her asking her millions of questions. But I said, Nancy, I'm concerned about China. They're sort of moving away from capitalism. It's not as business friendly. There's a lot of challenges to their property sector. What should I do with my emerging markets exposure in portfolios? And she looked at me and she said, Emily, my favorite emerging market is Middle America. And this is the theme that she was talking about. On the left-hand side of the page, we highlight why mid caps. Think mid caps, Midwest. It's relative or outsized exposure to the industrial sector. So these are companies in Middle America that are really directly benefiting from this onshoring theme. And we think that that could continue to have some legs into 2024. And then finally, mid caps are actually also cheap. So we're always looking for places to kind of balance out expensive technology stocks. Where can we look? And without getting into too much detail, this chart essentially highlights the fact that mid-cap equities are trading at the steepest discount to their large cap counterparts since the late 1990s. So we think that there's a really nice opportunity there to benefit from onshoring and own an asset that's kind of already priced for a not so great economic outlook. So I want to switch gears here and make sure we leave plenty of time for questions. And I want to go right to bonds. Now, bonds used to always be at the very end of my presentation because they were pretty much nothing but boring for most of my career. We've had low interest rates, low growth. They really haven't provided great total returns, but something happened over the last few years, which is that bonds now offer income. Remember how we just talked about paying 25% on credit cards or 7% on auto loans, elevated mortgage rates? You want to be a person that's receiving income right now, not a person that's paying it. It's a great time to be receiving income, and that really benefits bondholders. So before I get into this illustration, I just kind of want to explain what happened to bonds over the last few years. And the most important thing to know is that inflation is pretty much enemy number one of bonds. Higher inflation, higher commodity prices, which we saw and was exacerbated due to the Russia-Ukraine crisis. A Federal Reserve that's raising interest rates. It makes the value of the bonds you hold currently be less. So a lot of the basically worst things that could happen to bond investors happened, especially in 2022. We saw the worst year in history for bonds because that was really when inflation hit its highest level at 9% on headline CPI in June of 2022. So bond investors really got hurt. And when you looked at your statements, you probably were wondering, wait a second, I thought bonds were supposed to be the diversifier, the volatility buffer in my portfolio, and they just didn't work. Last year, especially the last couple of months of the year, bonds really started to come back. Why? Inflation started to fall meaningfully. In fact, we saw a couple downside surprises on the inflation data, and the bond market really liked that because that big enemy is starting to fade into the background. And we really think that that continues into this year. So a couple thoughts here on the Federal Reserve, because the Fed is kind of the key player in this bond market dynamic. The right-hand side of the page shows where the bond market thinks rates are going to go from here. So there's kind of betting odds out there of what the Fed will do next. And you can see that the market, and we agree with this, thinks that the last Fed rate hike is done. It was in July 26th of this past year. And that the Fed is going to hold and then start cutting interest rates to the tune of 5 to 6 rate cuts in 2024. So this is good news. Markets like it when interest rates come down. Again, it makes that cost of capital less and starts to make fixed income more attractive. The chart on the left shows the Fed funds rate. So again, reflecting what the Fed's doing with interest rates in the blue. And then the 10-year Treasury yield in the green. So the 10-year Treasury yield is kind of the proxy for bond yields out there that most investors think of. And what you can see is that yields fall. And by the way, that's the inverse of prices going up in periods where the Federal Reserve is cutting rates. So not only is the Fed funds rate coming down, but bond yields in general are coming down. And in fact, the 10-year Treasury yield that's kind of what most of us own, not the Fed funds rate, starts coming down even before, well before the Federal Reserve starts cutting. So we think that for that reason, that the math on bonds looks really, really good into 2024. We think investors could actually earn double-digit returns just owning high-quality bonds if rates can come down as they do typically do historically, and as the Fed starts cutting here. Now, of course, everybody loves what? Cash, CDs, right? CDs are actually paying a pretty elevated levels right now, paying out, and it's something that we haven't seen in a long time. And by the way, I'll tell you, I'm excited about the fact that there's something else that you can do with cash and earn some return on it. Here's the challenge, though. If you look closely at this chart, you can see when the Federal Reserve starts cutting, bond yields fall pretty fast. In fact, they fall about 2.5% from peak to trough. So you really want to start instead, and the challenge is, again, because they fall so fast, that 5%-ish that you may be earning on a CD right now, it's just not going to be available a year from now. Now, if you look at more of a intermediate core high quality bond strategy or portfolio of bonds, you can actually lock in 4 to 5% for years. So you're going to benefit from an income stream that's locked in for many, many years. So that's what we're recommending investors doing, getting out of cash vehicles for their longer term investments and thinking about owning a high quality core bond that has the ability to throw that income out for years and years. So we think you can simply get paid income right now for waiting as this economic contraction likely plays out. And potentially, we see some downside risk for equity markets. And we think bonds, frankly, can do some more heavy lifting in portfolios. So final slide here that I want to cover before we get to questions is around that bond math that I talked about. Don't worry too much about the details here, but what we did was we put together the current level on the aggregate bond index. So this is just a representation of high quality bonds. We looked at something called duration, which plays a big role in how bonds behave. You want longer duration as yields come down. And then we kind of put it all together to look at, what the total return potential could be if interest rates continue to come down. Remember, that's good for bond investors. And if history plays out the way it normally does, we're looking at a 2 to 3% 10-year treasury yield a year from now, which again could give us high single digit, low double digit returns, which is something that, frankly, I haven't seen in my career, and something that makes us more excited about bonds. I'll tell you, I've never liked bonds. As I mentioned, equities are always going to be a more powerful compounder of wealth over very long periods, but I think there's a unique opportunity here again to think about owning bonds. And I know it doesn't always feel that good, especially after the last couple of years of not getting great returns out of fixed income. So I'm going to go ahead and pause there again, because I want to make sure we have plenty of time for questions here, and take a look. I know Jenna has also been taking a look at the Q&A.
Yeah, we've had a couple questions come in.
Yeah.
First one is, what is normal for inflation and when will it get there? Also, will it stay there for a while?
Yeah, so that's a really great question. So the Federal Reserve has an inflation target of 2%. So they have a dual mandate. Their job is to maximize employment and maintain price stability, which means they want inflation not to be too hot and not to be too cold. Employment, we don't have to worry about. So the Fed's moves have been all about getting inflation to come down. So 2% I would consider normal, and that's really what we had for most of the last decade. And I think it'll stay that way. The way that I look at it is, first of all, we're getting closer. If you look at CPI, which is kind of the biggest piece of inflation data most investors consider, we just got a new read for last month, and core CPI came in about 3.7%. So still elevated, but the Federal Reserve calculates it in a really odd way, for lack of a more eloquent way of saying that. The way that they calculate shelter, which is the biggest component, so that's housing prices and rent, is really, really backward looking. If you actually, and right now it's saying that shelter prices are up 6.7% year over year. Frankly, that's wrong. If you look at real-time measures of rents, and we use a lot of different sources to do that, it's actually 0 to 1%. So my view is that we're already at the Fed's target of 2%. And by the way, I know it doesn't necessarily feel that way, but we're getting there. Now, why do I think it's going to stay there? Nothing's changed. The only thing that's changed is that we pumped $5 trillion of stimulus into the economy. And so what's happening is we basically turbocharge the economy, and it's taking us time to get all of that excess out of the system. And then we go back to where we were before. Why was inflation so low before? A big part of it is technology, AI. And technology is wildly disinflationary. Think about all of us right now. Normally I'd have to travel and get on a plane to come see all you, and here I am. We don't even have to buy fancy shoes anymore because we're all frankly wearing slippers underneath the table, right? With our jackets on top. Just kidding, Jenna, I'm sure you have some Jimmy Choos on or something like that. So anyway, so we're seeing this environment where we're just going to go back to that. Now that's good news. Maybe it means bond returns go back to being boring, but actually low inflation's really, been a decent environment, especially for growth stocks, given that low cost of capital and that ability to grow earnings off of it. I know that was a long answer, but it's a great question.
Yeah, thank you. Next question is, please discuss how to analyze who is issuing the bond and if there are any tax-free municipal bonds.
Yes, so we have a team here that manages a municipal bond strategy that's fantastic. Our portfolio manager came over from another firm, and he's built up this group, and they're experts at evaluating municipalities, looking at where the revenue is coming from. They have a tax-free strategy as well as a taxable strategy. So there's lots of different ways to think about investing in municipal bonds. They're offering the highest yields, near the highest yields that we've seen in over a decade. And munis have been an area, again, I really haven't spent much time talking about over the last decade until very, very recently, because you're talking about, a tax equivalent yield of somewhere between 6 and 7%, which I think is awesome. And by the way, municipalities are in great shape. Tax receipts, they're still up. They actually have to balance their budgets. Amazing to think about that, right? Municipalities. So I think there's some really nice opportunities there, and using an active manager in the space, I think, is critical.
Next, thoughts on global situation with respect to market.
So global situation, I'm assuming there's an element of like geopolitical dynamics playing out. I know there's a lot going on across the world in terms of different conflicts playing out. It's always tough, by the way, because there's so many to comment on this, because personally, it's just heartbreaking to see some of the things that are happening around the world. I have to put my investing hat on, unfortunately, in these situations. And frankly, markets tend to look past geopolitical risk. It can have an impact on volatility over the short term, but typically markets are focused on other things like fundamentals, earnings, where we are on the economic cycle, what the Fed is doing. The one thing that we're watching closely is the potential impact on oil prices, and they keep jumping around. We're right around $70-ish on WTI, kind of one step forward, two steps back. Because global growth is slowing, the demand side of the equation for oil prices is actually becoming an even, a similar, if not more important dynamic, kind of keeping a lid down on commodity prices. So that would be what we would be watching, but we're not making any investment decisions based on those geopolitical dynamics. Okay,
one more.
Okay.
Will technology ever slow down? If not, why bother owning anything else?
So here's the deal with tech. So, I quoted the entire tech sector is up 57% last year. There were some stocks that were up like way more than that, right? So tech was just on fire last year. Of course, it got hurt in 2022. If you like tech, by the way, you do want to be overweight the US. So international equities have a tiny technology sector. It's really found here in the United States. This is where all the innovation's happening. I will be honest with you, I have been overweight technology the entire 10 years that I've been putting this outlook together. I can never not like it. Again, higher quality, organic growth. But look, it's trading at really egregious valuations. In fact, the S&P 500 growth index, which is basically tech, is trading at a 45% premium to its long-term average. So that means investors are paying a ton for that future earnings growth. So we want to be mindful. I think it makes sense for tech to maybe take a little bit of a breather this year as we look for a rotation into other areas. But again, it's not something that I would downgrade, to be honest.
Okay, great. Thank you so much. Those are all the questions that came through.
Okay.
Really appreciate your time and your expertise and just all of the comments that you shared with us. That was just very insightful.
Thank you.
All right, so now we're going to shift gears a little bit to my piece, which is 2024 retirement planning considerations. And I'm going to take you through just some things to think about. And this will get personal for you, as well as give you some insight into what we're educating 401k participants on as well. So some of these pieces I'm going to share are exactly what I shared during my employee presentations, whether we're on site at a company or maybe I'm doing a virtual presentation like this. But we have found that, when it comes to finances and saving for retirement and 401k, a lot of people need help. We're not taught about these types of things in school. I feel schools are getting a little bit better, right? But a lot of things we're learning in our careers and our adult lives. And so we really like to be a resource for people and just walk them through these considerations. So this is a great time of year to kind of reflect, talk about the new limits and ways to save in 2024. I'm going to walk through some notable deadlines, talk about pre-tax versus Roth. That's a conversation we have often, and we'll continue to do that. And then also how to get back on track or get on track or maintain, a path towards retiring with the amount of money that you need and retiring when you want to. And first, I'm going to set the stage by talking about Social Security. So this really gives us that why behind why are we doing this? Why do we save for retirement? What is the big deal? What's the big benefit of a 401k plan, a 403b plan, IRAs? And for all of us, it doesn't matter our socioeconomic status, where we live, Social Security is not going to provide everything that we need to live off of in retirement. And Social Security was never created to replace everything that we need either. Plus, with longer life expectancies, Social Security really is just a part of our retirement income. And this is a look at how much as a percentage we could expect Social Security to replace depending on our earnings. So if you are on the very low or low end of earnings, sure, Social Security may provide over half of what you need, maybe even up to around 78, 79%. But the more you earn, the less Social Security is going to provide as a percentage of your pay. And so that gap, the lighter green, that's where we need to kick in. And that's where we need to have money set aside and saved for ourselves. And Social Security is really dependent on when you start taking your benefits and how much you've paid in, the average of your higher earning years during your career, and a lot of different factors. In fact, we have every summer, we have a webinar with a couple people from the Social Security Administration. That's a very popular webinar that we do. I have the recording of that. I can certainly send that to you. But this grid here is the age you're able to receive full Social Security benefits. If you're born 1960 or later, it's age 67. And this chart has not changed in a really long time. Let's look at an example. So let's say that my full retirement age for Social Security benefits is age 66. Sure, I can start to receive benefits earlier than that, as early as age 62, but then the benefits are reduced and they're reduced permanently. And on the flip side, sure, I can delay my benefits all the way out until age 70 and I'll get a little bit more each year. There's no benefit in delaying Social Security benefits past age 70. And here's a question we get from time to time as well. What if I want to receive Social Security while I'm still working? And the answer here really depends on this left-hand side. Have you met your full retirement age yet for Social Security? If you're under your full retirement age for Social Security, you can make up to $22,320 this year before that would start to negatively impact the benefits you receive from Social Security. The year you reach your full retirement age, you can make up to $59,520 that year. And then if you've already met your full retirement age, there's really no limit. And these dollar limits, they do change from year to year. So these are the new 2024 limits. We do encourage people to go out to the Social Security website. They've updated it. They've actually got some really nice tools and just I think a great interface, much better than they used to. And like I said, we have that webinar that we co-host with Social Security, and I'm more than happy to send that to anybody that would want it. They talk about Social Security and Medicare. So in our world, we talk a lot about the 401k, 403b space, right? So on the far left-hand side, that's primarily the space that we work in. And so the limits this year that anyone can save into a 401k, as long as their plan allows them to save up to the IRS maximum, is now 23,000. And if you're over age 50, you can put in an additional 7,500 catch-up contribution. And this did go up very slightly from 2023. And then the middle two columns are talking about individual retirement accounts. So both a traditional IRA funded with pre-tax dollars and a Roth IRA funded with after-tax dollars. And this year, IRAs have a combined limit of 7,000, and you can put in an additional 1,000 if you're over age 50. These limits too did go up a little bit from 2023. And I would be remiss if I didn't mention health savings accounts as not only a great way to save for current and future medical expenses, but HSAs are more and more starting to act like another retirement savings account for people, because after age 65, you can use money that has grown in your HSA account over the years on anything. You just have to pay regular income taxes on it if you use it for non-medical expenses. And those have a limit as well. So this year, if you're on a single high deductible health insurance plan, your limit to save into your HSA is $4,150. And if you're on a family plan, it's $8,300. If you're over age 55, you can put in an extra $1,000. And if you work somewhere that the employer funds part of your HSA, just be mindful that any employer contributions do get included in that annual limit. And these went up quite a bit from last year. And I would anticipate we'll continue to see more and more usage in health savings accounts. Here's just a graphical look at why HSAs are so great. Not only can you save into your health savings account with pre-tax dollars, but you can invest a portion of your account and it can grow tax deferred. And then you can take the money out tax-free for qualified medical expenses now or even in retirement. And then the nice feature on top of that is the flexibility. So as I mentioned, after age 65, you can use money from your HSA on anything, even non-medical. You just have to pay regular income taxes on what you take out there. Okay, so now let's talk a little bit more about individual retirement accounts. Again, we work more in the 401k, 403b space, but of course, individual retirement accounts come up in conversations. Can I do this? Should I do this? And I wanted to just point out some new limits and some considerations with IRAs. So you can individually always contribute the IRS maximum into an IRA. But if you earn too much and if you're covered already by a 401k plan, you may not get a deduction for contributing to an IRA. So this year, the deduction for a traditional IRA is phased out for singles and heads of households who are already covered by a workplace retirement plan and have modified AGI between 77,000 and 87,000. And if you're married filing joint, that phase out is 123 to 143,000. If you're contributing into an IRA and you're not covered by a workplace retirement plan, so in other words, you're not eligible for any 401k or 403b plan, but your spouse is covered, the income phase out is between 230 and 240. And then for Roth IRAs, so after tax individual retirement accounts, there's a phase out on your income, whether you can even do it or not. So in 2024, single and head of household filers with modified AGI below 147,000, you can contribute the full 7,000 to a Roth IRA. That's started to be phased out if your income is between 146 and 161, and you can't do it at all if your income is over 161. And then right underneath that, same thing, but for married couples filing joint, you can do it if your joint income is below 230,000. You are phased out if you're between 230 and 240. You can't contribute to a Roth IRA at all if your MAGI exceeds 240,000. Now, in our world, a lot of 401k plans nowadays do allow participants to save with both pre-tax and Roth dollars, which is great. It really increases the flexibility. It opens the doors for people that maybe can't do a Roth IRA. They can save Roth in their 401k plan. So these are, conversations that do come up, and more and more we're seeing adoption and usage of after-tax options inside company-sponsored retirement plans. So let's talk Roth options for high income earners. I just mentioned saving into the 401k that way. Some 401k plans even offer something called an in-plan Roth conversion, and that's where you can pick up some of your pre-tax dollars and convert it to Roth dollars. That is a taxable event. You do get a 1099. It's definitely something to consider the pros and cons, and we can help you and we can walk you through that. But we're seeing that as an option now inside a lot of retirement plans. And then there's the backdoor Roth IRA. It's a method that allows high income earners to roll money from a traditional pre-tax IRA into a Roth IRA. Wanted to quickly mention gift limit increases for this year. Contributions of up to $18,000 per individual or $36,000 per married couple filing joint qualify for the annual gift tax exclusion. And these amounts are up a little bit from last year. Also, you can gift as much as $85,000 individually and $170,000 jointly to a 529 plan. That's a college savings plan at one time, if it's treated as if it were spread over a 5-year period. Things that don't come up too much for us, but just wanted to put those in there. Some notable deadlines. So with IRA contributions for 2023, you have until April 15th of this year to make those contributions. Likewise, April 15th is the deadline for employer contributions for 2023, unless they filed a tax extension. And then for required minimum distributions, which are when you are retired, you need to start taking money out of your 401k. The RMD age changed to 73 at the beginning of 2023. For a long time, it was 73 and a half. Then it changed to 72. And about a year ago, it changed to 73. So if you are retired, you turn 73 in 2023, your first required distribution, you have until this April. However, going forward, you still need to take one every single year. Now, if you turn 73 in 2024, Your first RMD needs to happen by April 1st, 2025. You'd still need to take the 2025 distribution and annually going forward. One note here is if you are an owner of a company, whether you are still working or not, when you reach 73, you need to start taking required minimum distributions. So if you're in one of the plans that we're the advisor on, between our team and your provider, you should be reminded, although at the end of the day, just really be mindful about these required minimum distributions. So let's talk more about pre-tax versus Roth. This topic is something that comes up both on an individual basis for us quite a bit, as well as during our group presentations. I would say over 90% of our clients, the plans that we work on, do offer Roth contributions now, and soon all plans will be required to have the Roth contribution. But let's talk about the differences here about pre-tax and Roth. So traditional, in other words, pre-tax contributions on the left, anything you save into the retirement account, you don't have to pay taxes on, it lowers your taxable income, the money grows tax deferred, and then the withdrawals are subject to income tax. Still, a majority of people save this way because not only do you get the tax savings today, but the thought is, I would say for a majority of people, hey, I can hopefully live on less when I'm in retirement. So hopefully I'm in a lower tax bracket. Of course, we don't have a crystal ball on what taxes will be, what the different brackets will be when you retire, but that's the general thinking there. But on the right, with Roth after tax contributions, putting the money in, paying taxes now, today, on those contributions, you're having tax deferred growth and then tax free withdrawals after age 59 and a half. So you're saying, I'm going to get the taxes out of the way on the front end instead of on the back end. Why would you want to do that? Well, if you think your income will be higher in retirement, if you think your tax rate will be higher in retirement, Roth would make sense for you. Or perhaps you desire tax diversification. Perhaps you say, my taxes might be the same, who knows? Again, we don't have a crystal ball, but maybe you want to have at retirement different buckets to pull from. You'll have some taxable money, sure, but it would be nice to have also some tax-free money to pull from as well. There's been studies that it's kind of a curve, but in the earlier years of retirement, your spending will be higher, maybe staying more active, doing more things, traveling, perhaps continuing to pay off outstanding debt. Then perhaps your retirement spending will go down and perhaps increase towards the end of retirement if there's higher costs for long-term, healthcare facilities, things like that. And I mention that because it's something to think about where in retirement, it may be nice to have the pre-tax and Roth money. So if you have years where you're wanting to pull out more, you could pull out some of your Roth money without it bumping you into necessarily a higher tax bracket. So just different things like that. And age is a factor too. I mean, I see a lot of people in their 20s and 30s doing Roth just because the sheer amount of time that they'll have to invest and enjoy tax-free growth. And again, you may not be able to even save into a Roth IRA because of your income. So Roth 401k really opens the door for anybody to do it. And this is just a great reminder, I think, too, on your own personal savings rate. Something we talk about is every year, every other year, periodically try to come up with some sort of a system to increase what you save every once in a while. So maybe that's when you get a raise. Maybe that's just every January, kind of a reset for the year. Maybe it's when you file your taxes. You can even, with a lot of 401k, 403b providers, you can even set up automatic increases where the system will bump you up 1% a year, for example, until you hit your own personal cap. So those are just some examples, and we continuously encourage people to take a look at where they're at and make those small increases over time. It can make a big impact. These are just some examples, but we really like to show people some just real life, kind of tangible examples when it comes to how those retirement savings can add up. So we're looking here at a vending machine visit, a couple coffees a week, or going out to lunch a couple times a week. And it's not saying don't do that at all, don't have fun, don't enjoy, but it's saying, look, it's not as much as you think to save a little bit more to your retirement plan. Plus, add on top of that the compound growth. This is just assuming a 6% rate of return. And you can see on the far right hand side, over the course of 30 years, how those dollars can add up. Now, I know Emily shared some really great insight with us on market intelligence. Here's a few slides from JP Morgan's Guide to the Markets that sometimes I even show during employee presentations. So here's a look at the S&P 500 over the last 25 years or so. And so we show people how, yes, there is an upward trend. The average here is about 9% a year, but we have these seasons, these periods of time where we experience bear markets, and we may call out different time frames, like the beginning of 2020. Then we show the sharp growth year and a half post COVID, and then we show, say, 2022, the volatility we experienced there. And now look through January 12th, far right hand side of the screen, we are up 34% from that low in October 2022. And not that everyone cares about this much technical information, but it helps us with describing how staying the course can pay off over time, and just encourage them to just not be in their 401k accounts making a lot of changes, chasing returns, not looking at it every single day, and how most of the time, if you look at a calendar year, we end positive, and showing them those long-term positive returns. So this chart here, every gray line on this chart shows that calendar year's annual return. And we're just talking S&P 500 here. So in 33 out of the last 43 years, the S&P ended positive despite having intra-year declines. And those are the red dots on the negative axis. So this tells us, even if we have a poor year, a poor couple quarters, we don't need to react, because most of the time we end positive. In fact, for this time period, 1980 through 2023, the average annual return was 9%. Do we have years where we earn exactly 9%? Not really. I see one, so just kind of giving them that reassurance that they don't necessarily need to act, and that patience can really, really pay off. This is showing from 2001 to 2020 how there's really a case with sticking with your plan. So this shows if you stayed invested in the market that entire time, your annual rate of return in the S&P 500 was about 7.5%. Without just the 10 best days during that time frame, your annual rate of return is down to 3.35. And truly, I don't see a lot of people making frequent changes in their 401ks. I think for the most part, and with continuous education, people understand the value of staying the course, but it's a message that we want to keep repeating over and over. And then age. So age really ties into our conversations with participants. Generally speaking, the further you are from retirement, the more aggressive, the more in the market you may be able to invest. The closer you are to retirement, the smaller your time horizon is, the more conservative you want to be. Not that you'll ever be completely out of stocks, but we want to be mindful of that as you're nearing retirement. And this right here is the reason why we say that. That's the reason why we say what we say. So this is a look at different time periods from 1950 to 2023 with a portfolio either in stocks in the green, bonds in the blue, or a blend 60-40 in the gray. But let's look at stocks in green. Left-hand side, over a 1-year time period. So if you think of over these 73 years, taking a 1-year slice, the worst 1 year was negative 39%. That was 2008. The best 1 year was positive 47%. So we can see a lot of volatility in a 1 year time frame. If I'm 1 year from retirement, do I want to take on that amount of risk and have that potential volatility? No, I certainly don't. But next, let's move to a 5 year rolling period. The worst 5 year period was negative 3%, best was positive 28. So still pretty volatile. If I'm 5 years from retirement, I probably still don't want to be fully in the market. You can see a 10 year rolling period and then a 20 year rolling period on the right. The worst is still a positive 6% a year. The best is 17. So the more time you have, we could say if you have 20 plus years until retirement or, 15 plus years until retirement, you can be fully in stocks. So anyway, this is just giving you an idea of the basis of how we're educating people. So I talked a lot about saving in a 401k and investing, and we completely understand that the messaging of increase what you save, it sounds good, but in real life, it's not always feasible. And we really believe that in order to be prepared for retirement, we've got to have a handle on the other pieces of our financial wellness. So that's why we created our 8 steps to becoming financially well. It's out on our YouTube channel, it's on our website. It's a 8 video series, and they're all pretty short, 3 to 5 minutes, but it walks people through how they should prioritize these different pieces of their financial picture. So establishing an emergency fund, saving for retirement, understanding credit, paying down non-deductible debt. HSAs are in there. We talk about going back to your 401k, increasing that, saving for higher education expenses if that's a goal for you through a 529 plan, and then lastly, paying off your home early. So I do encourage anybody to go and watch these videos. Perhaps you've already taken care of a step or 2 or 5, but I still think that you would find a lot of nuggets in these short videos. So use this, share this completely on demand, no login. Okay, so I've covered quite a bit here, and again, this recording will go out to you. This will be housed out on our website as well as our YouTube channel. I wanted to show you too all of the different webinars we did in 2023. So all of these recordings are out also on our social channels. So you can see the variety of different topics we covered last year. Ones I had mentioned were the Social Security presentation, and in September, I did a deep dive on our 8 steps to financial wellness. Another really popular one was in November. We did an anticipating the unexpected, so estate planning and just things to consider and ways to set yourself up for your beneficiaries and your family planning. And then here's our plan for 2024. Of course, today we covered retirement planning considerations and had the market update. I'm going to be doing a 3-part fiduciary training this year. So if you are a plan sponsor, if you serve on a 401k plan committee, I'd really encourage you to attend those. You can register for some of these webinars already using this QR code. I used to do quarterly fiduciary trainings, and I would try to cover everything in 30 minutes. This year, I'm going to try to do a 3-part series and do more of a deep dive on different pieces of that training, if that makes sense. So again, if you serve on a plan committee, if you're a plan sponsor, certainly this would be a great resource for you as well. You can use that QR code to register for the first part of the 3, which will be in February. Thank you so much. It's 10:59. We covered a lot today. I really appreciated Emily's comments. Certainly let me know if you have any questions for her. If you have any questions to drop in the chat right now, feel free. Otherwise, you can give me a call, send me an email, and I am more than happy to help you out and answer your questions.